Hello learner, welcome to Manifested e-learning forum. My name is Emrin Ngwiri. I'll be taking you through equity investment analysis, and we are looking at technical analysis. In lesson 1 and lesson 2, we had looked at the mechanics that drive the technical analysis and also looked at the door theory, including the postulates of technical analysis. In lesson 3, we will specifically be looking at the following. Analysis. There. We will be looking at the moving averages. So under the moving averages, we are looking at the mathematical indicators. These mathematical indicators are what technicians use to try and infer an uptrend or a bullish market or a bearish market. We had already explained that in our previous lessons. Now, under mathematical indicators, we will specifically be looking at moving averages. That's the first kind of mathematical indicator. Specifically, we'll be looking at the simple moving average. There, and then we will move ahead and look at the exponential moving average. Exponential moving average. There. Once we've looked at those two moving averages, we will be able to now look at the oscillators. Oscillators, and specifically now we'll be looking at the rate of change. Yes, we'll be looking at the rate of change, like that. Once we've looked at the rate of change, we will now also move ahead and look at the relative strength index. Strength index, there. And then finally, we will be looking at the moving average convergence divergence. Moving average convergence divergence. There. What technicians call MACD. MACD. Moving average convergence divergence. There. Now, having looked at the mathematical indicators, we will look at the market indicators there. So we look at market indicators there. Now, under the market indicators, we will be looking at the breadth of the market. Then we'll move ahead and look at something else that talks about new highs and new lows. New highs and new lows. There. New highs and new lows. These are indicators that technicians use to try and predict the strength of the market or the strength of a particular trend. Now, we will also move ahead and look at short selling. Short selling there, and we will conclude this topic by looking at the odd lot trading. Odd lot trading, like that. Now, these indicators right over here are important for technicians because these are the ones that guide them to infer or make very critical decisions as to whether to buy a security or actually sell a security. So moving on, we will now start off at the mathematical indicators. Mathematical indicators. There. Now, the mathematical indicators, as described over here, we will first of all begin with moving averages. Now, under moving averages, there is the simple moving average there, a simple moving average, where we are saying is a description of where you will be able to have, if you have the period given to us there, and then we have the price of the security over here, and we're saying that the period 1, 2, 3, 4, 5, 6, 7, let's go up to 10, 9, 10, like that. The prices here you have 20, 23, 25. These are just hypothetical examples. 24, 28, 26, 25, 23, 20, and 21, like that. For you to conduct a simple moving average, say for example a 5-period or a 3-period moving average, what will happen is that you will be able to take any 3 like that. You get you sum them up and you get the average of those prices, and you plot them and you put them right over here. So you say, in this example, you say 3-day moving, 3-day moving average. 3-day moving average, like that. Now the 3-day moving average, what we're saying is that you'll add these 3 here. So let me pick my calculator right over here. And we say that now in this case we will have 20 plus 23 plus 25, like that. Equals, you divide by 3 because you're looking for the 3-day moving average. You have 22.67. 22.67. Notice where I'm putting the 22.67. It's at the midpoint right there. So the next figure, we get 23. We'll get now these 3 right there. So we have 23 plus 25 plus 24. Divide by 3, we have 24. Like that. Now these 3 again, we continue like that. 25, 24, and 28. 25 plus 24 plus 28. We have 77 divided by 3. We have 25.6. 25.6. Notice what we are doing. We are conducting a 3-day moving average for each 3-day period, so that now when we are plotting now the price over here, the price against time, like that, what happens is that we will be able to now plot, first of all, we'll plot the period against the price there. So probably you'll be able to have something like that. Just for example, that's what you're having. And then this 3-day moving average is what is going to reinforce the investor or the analyst in terms of whether there's going to be an uptrend or a downtrend. That is the way it is going to appear, like that. So it will have to start from some point in the middle over here. It will not start from the grid like that, from the x-axis, rather from the y-axis over here. It's just going to begin from the center and trying to be indicative of a trend, either up or down, like that. That is what a simple moving average is. So now we can be able to put it in writing and say, is that it represents an average of the security prices over time, and is useful to analysts and investors who would be able to infer a trend. Brackets, you can put bullish, bearish, or no trend. So once we have that now, we are saying that this can be able to assist technicians as well as investors to try and infer either bullish, bearish, or no trend. Now this is very useful, especially when you want to determine the strength of a trend. This case, you are not, you cannot be able to infer anything because this represents the congestion area where you're saying it's actually oscillating, moving up and down like that. So you can't be able to infer anything from that. Yeah. Now, having looked at the simple moving average, let's look at the exponential moving average right here. So we are right here, exponential moving average, exponential moving average, exponential moving average. Now, under the exponential moving average, you will be able to have to apply a formula that can be able to assist us to compute or get an indication of whether the strength of the market is actually moving up or moving down. Now, what we need to do is that we need to determine the following. We need to first of all get the formula for computing the exponential moving average, and the formula is as follows. We are saying the EMA, which you can be able to say is exponential moving average, right there, right there, is given as, and the first value we need to identify is we need to look at the previous EMA, exponential moving average. Previous, I will be able to explain exponential moving average, like that. Once we identified that, then we move ahead and we add the closing price. We add the difference between the closing price and the previous exponential moving average. So we add the difference between the closing price minus previous exponential moving average, and then you multiply by a constant there, which you're saying is f there. Now f is given as, so f is given as 2 over n plus 1, like that, where we are saying n represents the moving average that we're actually looking at. We've already explained the simple moving average. We said we use the 3-day moving average, so we can be able to have some hypothetical data over here so that we can be able to demonstrate how to compute the exponential moving average. So we are saying we've got period 1, 2, 3, 4, 5, 6, 7, 8, 9, and 10, like that. We have the price like that, 20, 22, 23, 25, 22, 26, 29, 20, 22, and 21, like that. That is just a hypothetical example. Now, in this case, to compute the exponential moving average for the first period, what we need to note is that for the first period, we will assume the price to remain the same over here as 20, like that. Now, once we have that, for every first period when computing the EMA, we will always assume that. Now, coming back to the formula, when come to the second period over here, we are saying we have the previous EMA, which we are saying the EMA previously. In this period right over here, period 2, the previous EMA is 20, right over here. If you'll allow me, I can use the formula, compute the formula right over here, or rather down over here. We can say the EMA is given as, now we are coming here, the previous EMA we've been given as 20, plus, now, the difference between the closing price right there. The closing price right now is 22. 22 minus the previous EMA. The previous EMA is 20, like that. And then this component f, or the factor, the constant f is considered. We are saying we are going to try and consider a 3-day moving average. So we are saying it's 2 divided by 3 plus 1. So we are saying it is 2 divided by 4, which we're saying is this is 1, this is 2, which is 0.5, like that. So that is how we compute the f over here. So the f we can say is 0.5. So to compute the EMA, the current EMA for today, how much do we get? Okay, we have 22 minus 20. We have is 20 multiplied by 0.5. We have 11, then plus 20, like that. Plus 20, and we have 31. Let me confirm that again. So it's 22 minus 20, and we have 2 times 0.5, and we have 1, and then plus 20. Plus 20. That's why it's always important to always confirm. This gives me 21, like that. Assuming now we continue like that, that's for the second period. For the first period, we have is 20. For the second period, we have as 21. For the third period, how much do we have? We are saying we'll have the previous EMA. The previous EMA is 21 plus the closing price is 23 minus the previous EMA. The previous EMA is 21 multiplied by 0.5. Notice the 0.5 will be constant because you're saying is 2 over 4, which you're saying is 0.5 there. So how much do we get? We say we have 23 minus 21, like that, and then we multiply by 0.5, then we add 21. We get 22. And so on and so forth. That is how you get the exponential moving average. So in trying to plot the price against the price against the period over there like that, and you're saying over here you have something like the price here against time, which you're saying is the same as the period. You will be able to plot this against the price, which will move like something like that, for example, and then we're saying the EMA will start from somewhere over here and move like that. That is a mathematical indicator that is used as well by technicians. Now, having looked at that, this brief description, that is how we are expected to compute the exponential moving average there. I don't need to put any description. It is pretty direct. You just need to understand the formula, the previous EMA plus the closing price, and the difference between the closing price and the previous EMA multiplied by a constant, which you're saying is F, and N represents the number of moving averages there provided there. Now those are the two. This is B right there. A is simple moving average, B is exponential moving average. Now we move on and look at the oscillators right over here. Now under the oscillators, you're trying to see whether how erratic a given market is. So we can say provide an indication of how erratic the market is provide an indication on how erratic the market is based on some computations, including the first one, which you're saying over there, is the rate of change. Number one, rate of change there. Now, looking at the rate of change as a way of trying to provide an indication of how erratic the market is, we are saying it is given simply by, this you can say is ROC, is given by, ROC is given as the current price divided by the price prevailing in period N plus 1. Price prevailing N periods ago multiplied by 100, like that. That is why we can be able to compute the rate of change. So you need to have the current price given to us over here, the price prevailing, say 1 year ago, like that. You divide by that and multiply by 100, you see the rate of change. Has it increased or has it decreased there? That provides an indication of the oscillation within the market there. Having looked at the rate of change, we now look at the second one, number 2, and based on our summary here, having looked at the oscillators, we've looked at the rate of change there, the relative strength index, Now, the relative strength index needs us to compute the relative strength of the market. And how do we compute the relative strength? We are saying, first of all, RSI, or the relative strength index, is given as 100, like that. Then we minus 100 divided by 1 plus the relative strength. Yes, the relative strength, like that. So this is minus there. So this is 1 minus. The RSI is 100 minus 100 over 1 plus the relative strength gives us the relative strength index. Now, how do we compute the relative strength? The relative strength is the average gains RS is given as average gain per day divided by average loss per day. That's how we compute like that. So if we have a listing, if you'll allow me to just try and put something over here, you have period 1, 2, 3, 4, 5, 6 like that, and you have them on day 1, maybe there's a gain of 5, a gain of 6, a gain of 2, and like that. Then on period 4, from period 4 to period 6, you had losses. So we're saying the losses include maybe say loss of 3, loss of 2, and loss of 2 there. So what we're saying is that you first of all compute the relative strength like that, the average gains over the average losses. So how much are the total gains? This is 5 plus 6 is 11. This is 13. That is in terms of gains. 5 plus 6 plus 2 like that. And then here we are saying you get the average losses. So it's 3. This is 5. This is 7 like that. So it's average gain over average losses. So in this case, the average, so we're saying is 13 divided by 3 and 7 divided by 3, and we divide those two, we get the relative strength. Once we have the relative strength, we come and plug that inside this formula over here. That will be able to help us and provide an indication of the oscillation within the market. So we get 100 minus 100 over 1 plus the relative strength. So let's just do it over here, so that we can be able to understand how we compute the relative strength index. So we are saying the average gain, we have 13 divided by 3 right there. I have the calculator right here with me. 13 divided by 3, we get 4.33. So it's 4.33, which is the average gains divided by the average losses. So we have 7 divided by 3. Like that is 2.33. 2.33. So how much do we get? 4.33 divided by 2.33, and we have 1.86. 1.86. Now that is the relative strength, and we come and plug that in there like as I was saying. So RSI is given as 100 minus 100 over 1 plus relative strength. 1 plus the relative strength is 1.86 there. Remember the law of Bodmer's? That brackets should begin first. So we're saying we have 100 divided by, open the brackets, 1 plus 1.86. 86, close the brackets, equals, we get 34.96. So 100 minus 34.96. Which we're saying is how much? 65.03. That is the relative strength. We are saying that the market is fairly strong, because you're saying the 50-point mark. 50-point mark is where now it's the middle ground between whether the market is actually weak, and on this other side is where the market is actually strong. So you can see 65 has actually passed the 50-point mark, and that's indicative that the strength of the market is fairly strong there, like that. So having looked at the relative strength index, we can move on and look at the moving average convergence divergence, mark D, which you're saying is a very important oscillator for technicians. Moving average convergence divergence, into brackets mark D there. So the moving average convergence divergence is a pretty simple concept, because it tries to indicate the strength of the market. And how do we compute the moving average convergence divergence? We are saying we just need to understand the strength of this indicator by looking at the strength or the premise behind the oscillators. We're saying the premise behind the oscillator provide an indication of how erratic the market is based on some computations, including those ones there. So we're looking at short-term exponential moving average, and that the difference between the short-term exponential moving average and the long-term exponential moving average gives us the moving average convergence divergence. So we're saying short-term, put it like so, short-term exponential moving average, or we can say, yeah, exponential moving average, like that, minus the long-term exponential moving average gives us the moving average convergence divergence, or what we're seeing the mark D there. Once we look at that, then we're seeing that will be an indication of the market oscillator, or the market, how erratic the market is there. Now, once we've looked at the oscillators, the mathematical indicators, now we move on and look at another concept that deals with the market indicators. This was the mathematical indicators. Please note, this is mathematical indicators. All these, we're talking about moving averages. And then now we're looking at the oscillators there. Mathematical indicators, now we're looking at the market indicators. The market includes either the fixed income market or even the equities market there. So we'll move on this side. Now, market indicators. The first one that we will be able to look at is the breadth of the market. The market. Now, the breadth of the market means what? It means that we are trying to look at how the market is, or the composition of the market. And it's a very simple concept where we are saying the information ratio is given as the information coefficient times the breadth of the market. That is the simple relationship that you need to understand as an equity expert. Where we are saying IR is the information ratio, that is the information about the market, and which is comprises of the information coefficient there, and BR represents breadth of the market. Now, how do we get the breadth of the market? It is just the difference between the average gains divided by the average losses in a given day. That is how we can be able to get the breadth of the market. We are also saying that the breadth of the market can also be gotten by the number of securities within the exchange. So we are saying the breadth of the market represents the number of securities traded in a securities exchange. Number of securities traded in a securities exchange. That is the breadth of the market. The information coefficient is the represents the skill of the manager, represents the skill of the manager in trying to predict the market up or down. That is the information coefficient. The information ratio is the ratio that relates to the information about the market, or you get an inference about the market there. So we can say information ratio, you can say information ratio provides an indication to technical analysts, to technicians about the factors that contribute to the return of a market. Return of a market. There. So we are saying the information ratio is linked with the information coefficient and the square root of the breadth of the market. The breadth of the market represents the number of securities. The information coefficient represents the number of skills, or the skill, how skillful the manager is in trying to predict either uptrends or downtrends. So the information ratio is also given as active return over active risk there. This is the return beyond the benchmark, which you can be able to run RP minus RB. This is the return of the portfolio. This is the return of the benchmark. Then we divide that against the active risk, which you are saying is the standard deviation of returns between the portfolio and the benchmark there. The difference in the risk between the portfolio and the benchmark. That's how we also get the information ratio coefficient. Now, having looked at the breadth of the market, let's look at new highs and new lows. Look at the breadth of the market, we look at new highs and new lows. Every time a technician tries to perform a trade within the market, what you need to understand is that the market will provide new highs and new lows every time, or every say 5 or so days, like that, because of what you're saying, the end of week effect, end of month effect. Those are calendar anomalies that affect securities exchanges all over the world. So this concept of the new highs and new lows is a pretty old concept, but it has an impact on trying to predict the market as whether it's going to move in an uptrend or whether the market is going to move in a downtrend here. So we say the new highs and lows is important in the prediction of market movements up or down, and we can say represents an indication, an indication of potential strengths in trend movement, indication of potential strength in trend movement for, we can say, for technicians. There. That is what we say about the new highs and the new lows. So if you keep on finding a securities market, if you can be able to probably use this other side to try and demonstrate or expound on that, what we can say is that if we have every time this is the price and this is time, and we find every time you find a new high every day like that, you find every time you're moving like that, you find a new high like that, it means that that is indicative of an uptrend like that. So this is a bullish market. So you find new highs every single day like that for, say, consistently for the past 1 month, that should indicate a bullish trend. However, if you have the contrary view or contrary opinion, where you have new lows every time that you are trying to identify the market trend like that, that indicates a bearish trend. That's why new highs and new lows is important for technicians to try and determine the nature of a given trend there. Now, having looked at new highs and new lows, let's look at short selling. There. Short selling is a concept that is pretty new in our market here in Kenya, because we are saying that the short selling regulations are being introduced by the Capital Markets Authority, where securities can be sold short. How does that happen? This is the exchange there. This is your firm. It is a dealer with the exchange like that. And these represent investors right here, both institutional investors and individual investors there. This firm can say, probably maybe we have another firm right over here like that, and this is the broker. So this is your firm right here. You go to a broker, you tell them, okay, that you need some to buy 1 million shares of KQ, Kenya Airways. The broker comes and tells you that fine, we will be able to offer you the shares, but we need to have a contract written down, and you need to sign, and we also need to sign, so that the contract can become binding. So the broker goes to the exchange, buys the 1 million shares like that, and now the shares are now with the broker. The broker can now offer them. Remember, there has not been exchange of money here. So they offer the shares to the exchange, to this company over here like that, at how much? So you're saying it's 1 million shares at, say, maybe 4.5 shillings like that. That means that shares worth 4.5 million shillings have been transferred from the broker to this firm here. Once those shares are received by X, they now avail them to these investors at a premium. Probably it is 1 million shares at maybe, say, 11.5, or let's say 10 shillings. Let's just, for convenience purposes, let's put a 10 shillings there. So we are saying that 10 million will move from these institutional investors or individual investors back to this firm. But remember, this firm right here had been provided or had borrowed shares from the broker over here like that. So now, since the proceeds are with firm X there, or this company here, what happens is that 10 million is with the firm. But what it did is that it borrowed from the broker. So it needs to pay up 4.5 million there. So now from the 10 million, using this dotted line overhead gives 4.5 million. That is the principal amount that had been provided by the broker. So 4.5 million, but there needs to be some form of interest that is paid from the proceeds there. So we can say plus an additional maybe 2 million. So you're saying this is the principal 4.5 plus the interest of 2 million. So now total comes to 6.5 million, like that. Now the remainder of the balance, which you're saying is 3.5, remains with Farm X there. So Farm X has made a profit from the usage of shares, or from the transfer of shares from the broker, which it did not ordinarily have. Well, that is what you're saying is short selling. Selling securities that do not belong to you. So we can be able to put that explanation in writing here. It is the process of selling securities that do not belong to you. Put it like that in quotes. It is the process of selling securities of selling assets based on borrowed funds or assets. There. So I've already explained what short selling is. Now trying to link it with the market indicators, we may not be having these short selling regulations having been finalized, but what we need to understand is that those short selling regulations, if an increased case of short selling actually happens, then that indicates the vibrancy of the market. So we can say if short selling is rampant, then the market is said to be very vibrant and is in an upward spiral. That saying bullish trend there. That is what you're saying is short selling. But of course, the contrary is where we are seeing the bearish market will actually happen. Now, having looked at short selling, we move on and look at the odd lot trading. Odd lot trading. Every securities exchange has an odd lot segment where you have securities that are not in multiples of say 100. For example, if you want to buy, the securities market is providing that the bid price is 4.5 for KQ. This is the buying price for KQ. You must come in multiples of 100 shares. So that means you can, for the minimum you can be able to buy in the main market segment is 4.5 times 100. You must spend 4,500, so that you can be able to buy 100 shares like that, or 450 rather, like that. It's 450. Sorry about like that. So this times 100 is 450 like that. For companies, say, which have got maybe say like EABL or East Africa Breweries Limited, which are going for so to the tune of maybe 320 shillings, you must come with 32,000 so that you can be able to buy 100 shares there. There is another segment apart from this main market segment where you must buy in multiples of 100, which we're saying is the odd lot segment. The odd lot segment now is where the shares are traded in multiples less than 100. You can find 99 shares, 96 shares, 98 shares there, 93 shares, 53 shares, or even 5 shares. are actually traded in that market. This is where investment banks and stock brokerage firms usually buy shares at a low price. The rule of the thumb is technicians need to buy shares at the lowest price possible and sell the shares at the highest price possible. So you are supposed to try and ask your broker, stock brokerage firm or investment bank, how much are the shares for Kenya Airways or for KQ going under the odd lot segment. Please don't go buying shares at the main market segment. Insist that you want to buy shares under the odd lot segment there. That is what stock brokerage firms and investment banks don't tell you. And it is unethical for the investment community to actually allow that to happen. What should happen is that I am telling you right now, you need to go and ask for the odd lot segment and buy shares right there. So odd lot trading is the process of buying and selling securities in the odd lot segment of an exchange. It is the process of buying and selling securities in the odd lot segment of a securities exchange. That odd lot of segment of securities exchange like that. Now that is what you're saying is the odd lot trading. You need to note and you need to underscore that or underline this statement that under the odd lot segment you will be able to find a significant discount in the prices of securities. A significant discount of securities prices are provided for under the odd lot trading. This brings me to the end of this topic review, and before I end, I need to give you a series of questions that you should be able to try and look at. The first question was tested in November 2016, question 5B. It reads as follows: explain the term technical analysis as used in equity valuation. Number 2, discuss 3 principles underlying technical analysis. Now, there is also another set of questions which I'll give you, and these questions came in May 2016, question 4A. It reads as follows: examine 4 principles of Doe theory in relation to technical analysis. Number 2, explain the reasoning behind support level and resistance level in relation to technical analysis. And finally, part 3, the exhibit below relates to Fairmore Limited, a company quoted at the Securities Exchange with a 50-day moving average and relative strength compared to Standard & Poor's S&P Industrial with 50-day moving average for the year 2014 and 2015. So you have the graphs indicated there. Required: interpret the chart output lines labeled 1 to 4 in A3 above. Thank you for having me as your guide. We hope that you can be able to join us in our next lesson. Thank you and God bless you.
Thank you for watching this video. Don't forget to get yourself a copy of our professionally prepared study text and revision partners. Visit our shop along Tom Boyer Street, Pioneer House, 3rd floor, opposite Fire Station.